So that's how hedge fund managers do it, and it's really a smarter way to manage a portfolio of stocks by beta weighting them, using the analysis tab, beta weighting your stocks against an index like the Qs, and then determining the number of puts that you want to buy on the Qs in order to hedge your position. Now, you can. I picked the 48s as the strike price, which is just about at the money here. But you could also go deeper in the money if you wanted a little bit more protection. Of course, it is going to cost you a little bit more. So if you wanted a little bit more protection, you could go up to the 50s. It'd give you a little bit more protection. Or you could use the 49s. It's really up to you how much protection you actually want. If you want to get totally delta neutral, all you have to do is play around with the strike prices. You get down to 15 or 20 deltas, you're pretty close to delta neutral here. My suggestion is to be a little bit long delta, maybe 15 to 20 or 50, rather than short delta, because you want the stocks to move up. That's why you bought them in the first place. So you can play around with the strike prices and the number of contracts any way that you want in order to determine the amount of risk you have. The longer the delta, the more risk you'll have on the downside. The less delta you have, the less risk you'll have on the downside. But that is totally up to you. Whatever is acceptable to you. So that's how I manage a portfolio of stocks using the indexes, and I think it's a smarter way to trade. And also, this is the way to build real wealth, especially if we're in a bull market in stocks. At this time, it's questionable whether or not we're going to have a bull market in stocks, because the market has actually gone down quite a bit. If we take a look at the quick chart, I don't want to time this as a but we've come down pretty heavily here over the last 6, 7, 8 months, and it's questionable whether or not we're in a bull market. So this type of a strategy can be used at any time. It can be used when the market is up to protect yourself from a downside draft that could wipe out a lot of the profit that you might have in stock that you already have. And if you already have a portfolio of stocks and you're not hedging those stocks with put options, or if you're not hedging a portfolio of stocks that you might have, I think that's a mistake, because you could wipe out a good deal of your not only profits that you may have on that, but also you're losing an opportunity to purchase insurance on your portfolio and then cashing that in later if we do have a big downdraft in the market, losing a lot of the Dow gains, or the S&P 500, or the NASDAQ. So this is a very smart way to trade. This is something that you can do on an existing portfolio of stocks, not just the stocks that you have. All you have to do is take your portfolio, bring them over to the Analyze tab, and beta weight this against any index, whether it's the S&P 500. Let's take the S&P 500 for a second. We're going to beta weight this against the S&P 500. I'm going to take these Qs out. I'm going to go over to the Trade tab, bring up the SPYs, and let's say we buy the at the money 130, which would be about the 135, 136. Let's go with the 136 puts here. Let's bring that over to our Analyze tab, and I'm just going to close these up a little bit. And we still got our stock position. Now, what happens when we buy one of these? Well, it brings our delta from 148 down to 98. We may have to buy 2 of those before we feel comfortable. We can also play around with the strike price. We can bring it down to 135. We can bring it up to 136. But by playing with the individual positions and taking a look at your delta, you want to be, like I said, you'd probably want to be a little bit long delta to capture some of the potential profits in the stock as it moves up. You should be doing this. You should be doing the purchase of your stocks anyway if you are slightly bullish. It's always better to be slightly bullish if you're buying stocks. And if you're not bullish, then maybe you should stay out of the market until you feel like you're bullish. But if you want to bring in your stocks and you want to portfolio weight them, you can weight them against the SPY like we did here. You know, we want to buy maybe 2 would be a nice little hedge against any downside risk in your portfolio. But you could also, you know, you could do it against anything. You could do it against the SPY, ETFs. You could do it against the Qs like we did before. You could do it against the diamonds. You know, if you have a number of stocks that are a portfolio already comprised of Dow Industrial stocks, you might want to use the diamonds as a hedge. You know, use the diamonds in order to hedge your position. Really, the options here are quite unlimited. So that's how you hedge your positions. That's how you make money in the stocks. It's a terrific way to limit your downside. It's an absolutely dynamic way to trade. It gives you unlimited upside potential on any stock that you might own, and it limits your downside risk to those stocks. And in fact, the way I've told you to trade is to use that insurance policy by buying those puts, and when the stock goes down, cash in that insurance policy to buy more insurance at a lower price, but also to use the excess cash that you've generated in order to buy additional shares of stock. You know, eventually, you know, I gave you an example of one particular trade that had initial investment of $14,000. Well, what happened was that the stock continued to go down, and then it went up, and then it went, it went down again, and then it went up again, and eventually a 1,000-share position turned into a 4,000-share position because of all the insurance that I was able to cash in by cashing in the puts. And then eventually there was a large rally in the stock, and it turned into a $75,000 position from a $14,000 position with absolutely no additional investment necessary. And that was in NVIDIA. There was a tremendous amount of, it was just, NVIDIA's just been it was a terrific ride. I mean, it was up, it was down, you cash in your puts, let's say you purchased, this is pretty interesting, let's say you purchased, 1,000 shares at $20 here. And over the period of, this is a weekly chart, but, if you go back to some of these periods here, you had some pretty dramatic price movement here. And you could have cashed in those puts that you had to buy additional protection and then buy more puts. Well, when you cashed in those puts, you bought more shares at the same time. So starting out with 1,000 shares, you could have cashed in some puts here. You could have bought another couple hundred shares, bought some more puts, cashed in here, bought another few hundred shares, bought some more puts, cashed in here, bought some more puts. Cashed in your puts from the previous purchase and bought some more shares. But eventually, by the time you get down to this point, instead of 1,000 shares, now you've got maybe 3,000 shares, and you've got this huge run up here, in which you just make just an absolute ton of money. So that's how you really build wealth, and you build it very, very quickly in the markets by doing exactly this type of trading. All right, guys, that's it for this part. Trade with confidence.